In this video, we'll look at the methodology based on the academic research on value stock selection conducted by Professor Joseph Piotroski, who currently teaches at the Stanford Graduate School of Business. The key investing insight behind this model is the following. Many value stocks are cheap for a reason, but by separating out those companies with the best future prospects using a series of financial strength tests, you can enhance the returns of a value strategy. We'll get into the details in a moment, but the overarching approach here is the strategy starts by looking at the 20% cheapest stocks in the market using the price to book ratio. It then applies a series of 9 tests to calculate a score known as the F-score, which attempts to separate out those companies with the best future prospects and financial strength from those that don't have those characteristics. The F-score looks at variables like cash flow, return on assets, the current ratio, and asset turnover, among other things. The source and the evidence behind the model: the strategy was extracted from Piotroski's research paper, Value Investing, the use of historical financial statement information to separate winners from losers. By buying the top F-score rated stocks and shorting the worst, Piotroski showed, through his historical testing in his paper, a 23% average annualized return from 1976 to 1996, a return that more than doubled the S&P's gain over that same time period. The investment thesis is this: by combining value stock selection and identification with financial strength measures, investors can give themselves a good chance at finding those value stocks that go on to perform well versus those value stocks that end up actually being value traps. As I mentioned, this model seeks out 1, value stocks, and 2, tries to determine the financial strength of companies through a series of tests. The first step in the model is to isolate those value stocks, or the cheapest stocks in the market. To pass this test, a company needs to be in the top 20% of the market based on the book-to-market ratio, which is just the inverse of the price-to-book. So it's looking at the lowest or the cheapest stocks in the market based on the price-to-book ratio. From there, companies are put through a series of 9 different tests. I've broken these out into specific sections. First is to assess the firm's profitability. So this criteria, 1, looks at the return on assets for the most recent fiscal year and wants to see that as being positive. And 2, the return on assets for the most recent fiscal year must be greater than the return on assets from the previous fiscal year. The second category is cash flow. The first criteria here wants to see cash flow from operations for the most recent fiscal year to be a positive. And then it looks from cash flow from operations for the most current fiscal year to be greater than net income for the most current fiscal year. The third category is looking at leverage and financial solvency ratios. So first, it looks at long-term debt in relation to assets, and it wants to see that that ratio for the most recent fiscal year be less or equal to the ratio from the previous fiscal year. The next criteria, it looks at the current ratio, and it wants to see the most recent fiscal year's current ratio be greater than the current, equal to or greater than the current ratio from the previous fiscal year. Lastly, there's a fourth category which includes many different metrics, including share buybacks, margins, and asset turnover. So first, the model likes to see that shares outstanding for the most recent fiscal year is less than or equal to shares outstanding for the previous fiscal year. Next, it wants to see that gross margins for the most recent fiscal year be greater than gross margins for the previous fiscal year. And lastly, asset turnover for the most recent fiscal year must be greater than asset turnover for the previous fiscal year. For investors looking to identify value stocks but want to make sure that the firms pass a series of financial strength tests, the Piotroski book-to-market model may be a good place to start.